Welcome to the Retirement Wealth Podcast. Today we're diving into a topic that's really exciting for anyone thinking about long-term financial stability.
Absolutely, Emily. We're going to explore how to invest in dividend growth stocks for retirement, which can be a game changer for your income strategy.
Right. Many folks are looking for ways to make their money work harder for them, especially as they approach retirement.
Exactly. Dividend growth stocks can provide not just income, but also the potential for capital appreciation over time, which is so important for preserving and growing wealth in retirement.
We'll discuss what dividend growth stocks are, why they're a solid choice for retirees, and how to build a portfolio that can sustain your lifestyle.
And we'll also touch on some strategies for selecting the right stocks and managing your investments as you transition into retirement.
I'm really looking forward to that. It's all about creating a financial plan that gives you peace of mind, right?
Yes, and the beauty of dividend growth stocks is that they can offer both income and the potential for growth, which is critical in today's financial landscape.
So let's jump into it. First off, David, could you explain what exactly dividend growth stocks are and why they might be particularly appealing for retirees?
Emily, when we talk about investing in dividend growth stocks, it's not just about the numbers on a spreadsheet. It's really about the peace of mind that comes with having a solid plan, especially right now.
Absolutely, David. With everything happening in the economy, it seems like the stakes are higher than ever for folks nearing retirement.
Right. Take inflation, for example. We've seen prices rise significantly over the last couple of years. If you're relying solely on fixed income, like bonds or cash savings, you might find that your purchasing power is eroding faster than you expected.
That's a great point. And then there's market volatility, too. Many people are worried about what happens if the market takes a downturn right when they're about to retire.
Exactly. And that's where dividend growth stocks come in. They can provide a steady income stream that grows over time, which can help counteract some of that volatility.
I've heard stories about retirees who had to rethink their whole retirement plan because of unexpected market drops.
Yes, I know someone. Let's call him Tom. He was planning to retire last year, but with the market fluctuations, he felt he had to delay it. He was worried about running out of money,
That sounds stressful. So how could dividend growth stocks have helped him?
Well, if Tom had included dividend growth stocks in his portfolio, he might have felt more secure. These stocks not only provide regular income, but historically, they tend to be more resilient in downturns. Plus, many companies that offer dividends have a history of increasing those payments, which can help offset inflation.
That's a win-win. And, speaking of inflation, I think many people underestimate how it affects their retirement plans.
Absolutely. It's easy to think, oh, I'll just live off my savings. But if those savings aren't growing, or if they're losing value due to inflation, that can be a real issue.
Right, and then there's the question of taxes. Taxes can eat into your retirement income too.
Yes, and that's another area where dividends can shine. Qualified dividends can be taxed at a lower rate than ordinary income, which can be more tax efficient for retirees.
That's a crucial consideration. And then there's the whole Social Security aspect. With potential changes looming, it's tough to rely solely on that income stream.
You're right. With the Social Security Trust Fund projected to face challenges in the coming years, diversifying your income sources becomes even more vital. It's about creating a robust financial strategy that can withstand those uncertainties.
And let's not forget about healthcare costs. They can be a huge burden for retirees, and they're only expected to rise.
Exactly. I've seen it with clients. They've planned for their lifestyle, but then unexpected medical expenses can derail everything. Having a strong income stream, like from dividend stocks, can help cushion that blow.
That emotional aspect of financial security is so important too. People want to feel secure in their retirement, not just financially, but emotionally as well.
Yes, and feeling secure can help retirees enjoy their time rather than stressing over their finances. I've had clients tell me how much more relaxed they feel knowing they have a reliable income source, which allows them to focus on what truly matters, like spending time with family or pursuing hobbies.
Those are the moments we want to cherish. So would you say that legacy planning is also a part of this discussion?
Absolutely. Many people want to leave something behind for their loved ones. Investing in dividend growth stocks can not only provide for your needs during retirement, but also create a potential legacy. The idea is that, over time, you can build wealth that can be passed down, you know?
That's a great point. It's about creating a lasting impact, not just for ourselves, but for future generations.
Exactly. And with current economic trends, having a diversified portfolio that includes dividend growth stocks can help mitigate risks and provide that long-term growth.
It sounds like now is an especially critical time to consider these strategies, given everything we've discussed.
Yes, and it's essential to have a clear strategy in place. Each person's situation is unique, but understanding the benefits of dividend growth stocks can be a game changer.
So, what are some core strategies you recommend for someone looking to get started with dividend growth investing?
So, Emily, when we talk about investing in dividend growth stocks for retirement, one of the core strategies is understanding how to allocate your assets effectively. It's really about balancing risk and reward, right?
Absolutely. And I think a good rule of thumb is the 70/30 portfolio, where you might have 70% in stocks, including dividend growth stocks, and 30% in bonds. That mix can really help manage volatility as you approach retirement.
Exactly. And when we're looking at dividend growth stocks specifically, it's important to focus on companies with a strong history of increasing their dividends. Think about it. Companies like Johnson & Johnson or Procter & Gamble have raised their dividends for decades. That's what you want to see.
Right. And those consistent increases can help outpace inflation, which is a huge concern during retirement. If you're relying on fixed income, that can be a real risk, can't it?
For sure. And if you're thinking about tax-advantaged accounts like a 401k or an IRA, it's smart to hold dividend stocks in those accounts. This way, you defer taxes until withdrawal, which can save you a chunk of change over time.
That's a great point. And then there's the Roth IRA, where you can withdraw your earnings tax-free in retirement. That's super valuable, especially if you expect your tax rate to be higher later on.
Yes, and let's not forget about Social Security. It's like the foundation of your retirement income. You can strategize when to take it based on your needs. If you wait until age 70, your benefits can increase significantly.
Right. So if you can afford to delay, you're looking at about an 8% increase per year. That's pretty substantial.
Exactly, and that can really complement your other income streams like dividends or annuities to create a stable cash flow.
Speaking of annuities, they can be a great way to guarantee income, but it's important to understand the different types, like fixed versus variable. They each come with their own benefits and risks.
Yes, and if we pivot back to stocks, the withdrawal strategy is crucial. The 4% rule is a classic guideline, suggesting you withdraw 4% of your retirement savings each year. This can help ensure your savings last through your retirement years.
Right, but it's not a one-size-fits-all approach. Some folks might need to adjust that, depending on their lifestyle or healthcare costs.
Absolutely. And that's where the bucket strategy comes in. You could create different buckets for short-term and long-term needs, using safer investments for immediate needs and growth investments for later years.
That makes a lot of sense. So, for example, you could keep a bucket with cash or short-term bonds for the first few years, and then have another bucket with dividend growth stocks for later withdrawals.
Exactly. And diversification is key throughout this process. You want to ensure that you're not overly reliant on one asset class. Like, if all your investments are in tech stocks and the market takes a hit, that can really hurt your retirement plan.
For sure. And speaking of diversification, it's important to consider different sectors when investing in dividend-paying stocks. Some sectors, like utilities or consumer staples, tend to be more stable, while others, like technology, can offer higher growth potential but come with more volatility.
Yes, and looking at the historical performance of these sectors can give you insights into how they might perform in the future. For instance, during downturns, defensive stocks often hold up better.
That's a smart way to approach it. And what about tax savings techniques? There are definitely ways to keep more of your hard-earned money, right?
Yes, tax loss harvesting can be an effective strategy. If you have losing investments, you can sell them to offset gains elsewhere, which can lower your overall tax liability.
That's a great tip. And another thing to keep an eye on is required minimum distributions, or RMDs, which kick in at age 72. You'll want to plan for those, so you're not blindsided by a big tax bill.
Exactly. If you have a lot of tax-deferred accounts, it's wise to think about how RMDs will affect your income and tax situation in retirement. That's where a good financial advisor can really help. to navigate those waters.
And it all circles back to having a solid plan in place, doesn't it? You want to set up your investments so that they work for you, providing the income you need without risking too much.
Absolutely. It's all about making informed choices, understanding your needs, and regularly reviewing your strategy.
So with all these strategies in mind, are there common pitfalls that people should look out for when investing in dividend growth stocks?
Definitely. And that's a crucial area to discuss. One of the biggest pitfalls is chasing yield. Some investors get so focused on high dividend yields that they overlook the underlying health of the company.
Right, because a high yield could be a sign of a troubled company trying to attract investors before cutting dividends.
Exactly. And that's why it's essential to analyze the dividend payout ratio, which is the percentage of earnings paid out as dividends. A ratio above 60% might raise a red flag, suggesting the company could struggle to maintain its dividend.
And let's not forget about market timing. Some people try to buy and sell based on short-term movements, which often backfires. It's better to stay focused on the long-term performance and fundamentals.
Yes, the market can be unpredictable, and that brings us back to the importance of having a diversified, well-researched portfolio. It's really about building a solid foundation for your retirement. So, Emily, one of the biggest pitfalls I see with retirees is this thing called sequence of returns risk. It's when the order of your investment returns affects your portfolio's longevity. If you happen to face poor returns early on in retirement while you're withdrawing from your investments, it can really throw your plan off track.
Yeah, that sounds really tough. Can you give me an example of how that plays out in real life?
Absolutely. I once worked with a couple, let's call them Tom and Linda. They were so excited to retire, but they had a significant market downturn just after they started withdrawing from their savings. Instead of a steady return, they faced negative returns in those first few years. It was like pouring water into a bucket with a hole in it. They were taking money out, and their investments were losing value.
Wow, that must have been stressful for them. How did they cope with that situation?
Well, they had to make some tough choices. They had to cut back on their spending, which is never easy, especially after dreaming about retirement for so long. It really highlighted the importance of having a diversified investment strategy and a withdrawal plan that takes market volatility into account.
That makes sense. And speaking of planning, what about taxes? I've heard that many retirees overlook the tax implications of their withdrawals.
Exactly. That's another common mistake. A lot of people just assume their tax situation will be simpler in retirement, but that's not always the case. For instance, if someone is withdrawing from a traditional IRA or 401k, they can end up being surprised by a larger tax bill than expected, especially if they're also collecting Social Security.
Right, and that could really eat into their retirement income, can it?
Yes, it can. I had a client, let's call her Susan, who was thrilled to finally retire. She started withdrawing from her traditional IRA without thinking about the tax consequences. By the time tax season rolled around, she found herself in a higher tax bracket. It wasn't just a little surprise. It was a significant hit to her budget.
Ouch. So what should people consider to avoid that kind of situation?
Well, it's crucial to have a comprehensive tax strategy, planning your withdrawals to minimize taxes, considering the tax implications of Social Security benefits, and even looking into tax-efficient investment accounts can make a big difference.
That's a great point. And then there's healthcare, right? That's another area where people tend to underestimate their needs.
Absolutely. The cost of healthcare in retirement can be staggering. Many retirees don't factor in expenses for long-term care or even just routine healthcare costs. I worked with a gentleman, let's call him John, who thought his Medicare coverage would be enough. But when he faced unexpected health issues, the out-of-pocket costs piled up quickly, and he wasn't prepared.
That sounds really tough for him. It's hard to plan for something so unpredictable.
It is, and that unpredictability can lead to financial stress. I always recommend building a healthcare budget well in advance of retirement. And considering options like long-term care insurance, even if it feels like a big expense up front, can really pay off in the long run.
That's such sound advice. Now, what about asset allocation? Are there common mistakes retirees make there as well?
Definitely. Many retirees hold on to a portfolio that's too conservative, thinking that they need to prioritize safety over growth. But, with inflation, that can erode purchasing power. I had a couple, let's call them Bill and Nancy, who were very risk-averse. They shifted almost everything into bonds and cash. While they felt secure, they were losing ground against inflation year after year.
That's a big revelation. So it's about finding that balance between safety and growth, right?
Exactly. A well-thought-out asset allocation strategy is crucial. It's about having a mix that aligns with your risk tolerance and your time horizon.
And what about Social Security? I know there's a lot of discussion about when to claim benefits. What's the most common mistake there?
Claiming too early, for sure. A lot of people don't realize that by claiming Social Security at 62, they could be leaving a lot of money on the table, especially if they live longer than they expected. I had a client named Eric who claimed early, thinking he'd need the money right away. But he didn't account for the fact that delaying benefits could have increased his monthly income significantly.
That's something a lot of people might overlook. It sounds like it's really about understanding how long you might need those benefits.
Absolutely. It's also about evaluating your overall financial situation and health. If someone is in good health and can afford to wait, they may benefit from delaying their claim.
So if someone hears this and realizes they might be making some of these mistakes, what can they do to get back on track?
First, they should revisit their retirement plan and consider consulting with a financial advisor who can help them assess their situation. It's never too late to make adjustments. They can also build a more flexible withdrawal strategy, consider tax implications, and ensure they're adequately prepared for healthcare costs.
That sounds like a solid plan. It's all about being proactive and making informed decisions, right?
Exactly. Staying educated and aware of these common pitfalls can really help retirees navigate their retirement years more smoothly.
And it's about enjoying that time without the added stress of financial worries.
Yes, and staying flexible in your planning will help you adapt to whatever life throws at you.
Such great insights, David. I think this conversation is going to help a lot of people think critically about their retirement strategies.
I hope so. It's all about empowering yourself with knowledge and planning ahead. It can make all the difference. All right, Emily, so let's dive into some actionable steps listeners can take right away to start investing in dividend growth stocks.
Yeah, I love that. The more practical advice we can give, the better.
Exactly. First off, I'd recommend that everyone takes a moment to review their current investment portfolio. Just assess where you stand. Look for those dividend-paying stocks you might already own and evaluate their performance.
That makes sense. A quarterly review could really help keep things on track, right?
Absolutely. And while you're at it, you can run some retirement projections. Many brokerage firms like Vanguard, Fidelity, and Schwab offer retirement calculators. They're super user-friendly, and they can give you a clearer picture of how your investments are working for you.
Right. And I think those tools can help you set realistic goals, too. What about tax considerations?
Great point. It's essential to think about taxes, especially with dividends. The IRS has different tax rates for qualified and non-qualified dividends, so using tax software can help you understand your potential tax obligations. Websites like SSA.gov can also provide insights into your Social Security benefits, which is a big part of retirement planning.
Yeah, and it's never too late to improve your plan, right?
Exactly. Another good habit to develop is to regularly reinvest your dividends. Many brokerages allow you to set up automatic reinvestment plans. This can really compound your growth over time.
That sounds like a smart move. And speaking of habits, what about keeping up with financial news and trends?
Definitely. Staying informed is key. There are some fantastic books and podcasts out there that can help. For instance, The Intelligent Investor by Benjamin Graham is a classic for understanding investing principles. And Invest Like the Best is a great podcast that features expert insights.
Ooh, I've heard of that podcast. It's really popular, isn't it?
Yes, it is. And there are also online communities like forums on Reddit or Bogleheads where you can discuss strategies and learn from others. It's really supportive, and you can gather real-life experiences.
That's a great tip. I think connecting with others can be so beneficial for motivation, too.
Absolutely. And as you're making these changes, consider setting small, achievable financial goals. For example, aim to increase your dividend income by a certain percentage each year. It doesn't have to be drastic. Small steps can lead to big changes.
I love that idea. It feels manageable and less overwhelming.
Right? And don't forget to review your expenses as well. Sometimes it's just as important to look at what you're spending. You might find areas to cut back, which could free up more money for investing.
That's a good reminder. It's all about balance, isn't it?
Exactly, and let's not overlook the importance of working with a financial advisor. If you feel overwhelmed, they can help tailor a plan that suits your specific needs and goals, especially when it comes to dividend investing.
For sure. So to recap, we've talked about reviewing your portfolio, using retirement calculators, understanding taxes, reinvesting dividends, and setting small goals.
Yes, and we mentioned resources like books, podcasts, and communities you can connect with. Each of these steps can help you feel more empowered in your retirement planning.
It sounds like there are so many tools available to help simplify this process.
Exactly. You don't have to tackle this all at once. Just take it one step at a time.
And the best part is that it's never too late to start making these improvements, right?
Right. So those are some practical first steps. Now let's bring this all together. Well, Emily, it's been quite the discussion today about investing in dividend growth stocks for retirement, hasn't it?
Absolutely, David. I think we covered some really valuable points. One of the key takeaways is the importance of focusing on companies with a solid history of increasing dividends, right?
Exactly, and those companies often reflect strong financial health and a commitment to returning value to shareholders. It's a great indicator for retirees looking for stability.
Yeah, and we also talked about diversification, making sure you're not putting all your eggs in one basket. That's crucial, especially as you approach retirement.
Right, spreading your investments across different sectors can help mitigate risks. Another point was the power of reinvesting dividends, which can significantly boost your overall returns over time.
And let's not forget about doing your homework. Researching potential investments and understanding the market trends is essential, especially for those who are new to dividend investing.
Definitely, staying informed and adaptable can make a huge difference. It's all about building and protecting your retirement wealth, so you can enjoy those golden years without financial stress.
Absolutely. And to all our listeners, we encourage you to share your biggest takeaway from today's episode. If you have any questions or thoughts, we'd love to hear them.
And don't forget to like and subscribe to the podcast. Sharing this with someone who's planning for or already in retirement can really help them navigate their financial future.
Yes. And next time, we'll dive into an intriguing topic: how to use tax loss harvesting in retirement. It's a strategy that could really optimize your tax situation.
That's right. So stay tuned for that.
Thanks for joining us today, everyone.
Yeah. Thank you all for listening.
Until next time, take care and happy planning.
Bye for now.